Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Currency Analyst at MUFG. It's Friday, 22nd July 2022, and joining Lee to pose some questions on the financial market themes for the week ahead is Simon Mays, Director of MUFG's Global Customer Marketing Group for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hey Ali, it's been an interesting week with the heat waves here, so I hope you've survived it virtually unscathed. Talking of feeling the heat, so the dollar has been on the back foot this week against a few of the majors. I think sterling, euro and yen have all finished higher against the dollar this week. So what do you think the reasons for that are?
Hi, Simon. Yeah, it's good question. Certainly this week we have seen the dollar correct lower after obviously a very strong run over the last month or so. And we think this is kind of reflecting two key reasons. One, this week we've seen quite a decent rebound for global equity markets and other risk assets like commodity prices. Probably the best kind of rebound we've seen in global equity markets really since the bear market started for equity markets this year. So that improvement in risk sentiment has certainly taken some of the shine off the dollar in the short term. Admittedly, we still think at this stage this is probably more likely just a kind of bear market rally for equity markets, and we don't see this as the sort of start of a more sustained improvement in global risk sentiment, which would obviously be more of a negative story for the dollar. And then secondly, the other driver for dollar weakness this week has also been the pullback that we've seen in US yields. So market participants have becoming certainly more confident that the Fed, when they meet next week, is seen as more likely to just raise rates again by 75 basis points rather than consider the possibility of a kind of bigger hike of, say, 100 basis points. If you remember back, expectations kind of peaked for a 100 basis point hike just after the release of the June CPI report. But since then, over the last week or so, the market has kind of pared back those expectations, and kind of two main reasons for that. One has been the comments from Fed speakers over the last couple of weeks. They've sort of pushed back against expectations of a bigger 100 basis point hike. And then secondly, on top of that, we've also seen the data, particularly this week, has come in on the much softer side from the US. We've had a very weak Philly Fed survey and also PMI data for July, which has increased concerns over a sharper slowdown in US growth. So that's kind of encouraged the US rate market to kind of pare back expectations for the Fed to continue to deliver larger rate hikes.
So I think not too long ago, like you said, the market was expecting potentially 100 basis points in July and 75 in September. So what's our forecast now for those two meetings?
Yeah, our kind of base case scenario from our New York rate strategist is he's still looking for a 75 basis point hike this month, in line with the consensus. But he is then looking for the Fed to slow down the pace of tightening and revert back to 50 basis point hikes in September. He's always been of the view that we're likely to see more and more evidence coming through of a sharper slowdown in US growth, weakness in financial or tightening of financial conditions as well. And to him, that makes the case for the Fed to start to rein back the pace of tightening. So that certainly seems to be kind of playing out that way at the moment, although we're not expecting the Fed ourselves to signal clearly that they're looking to slow down tightening at next week's meeting. We still think the overall message will be very hawkish from the Fed, which will keep alive expectations for a 75 basis point hike in September as well. And I think the focus from the Fed at this stage is still going to be very much on trying to get inflation down, and that requires them to be very, very aggressive in terms of raising rates still, because we're still talking about a policy rate which is still in easy conditions right now, and to get into more restrictive territory above 3%, they need to still deliver a number of larger hikes going forward.
Yeah, and I guess in slight contrast to this more or slightly more dovish focus on the Fed, the ECB this week hiking 50 basis points, and a slightly different message from them. So how does that alter our forecast and our view on Eurodollar?
Yeah, it's a good question. I think certainly the ECB's decision to deliver more front-loaded tightening and basically removing negative rates in one fell swoop with a 50 basis point hike, that initially did help to support a stronger euro. But as we've seen, just because the ECB is going to raise rates potentially more quickly in the very short term, that doesn't necessarily on its own mean that the euro is going to strengthen on a more sustained basis going forward. So we still are sticking with our kind of bearish near-term outlook for the euro. We still think ultimately that other factors are more important right now in terms of driving euro performance. One being increasing concerns over a sharper slowdown / kind of recession in the eurozone, either later this year or early next year. Certainly those fears have been reinforced further today with the release of the much weaker than expected PMI data from Europe, which pointed towards an increased risk of GDP contraction in the third quarter. So certainly those kind of recession fears in Europe, we think will continue to weigh on the euro. And those fears obviously still reflecting the risk of more disruption coming through from energy supply disruption in Europe. Obviously, we've had some relief this week that the Nord Stream 1 pipeline has resumed and gas supply is coming back through from Russia. But we still think with supply still down by about 60% from full capacity, that's not a good situation for Europe's economy, and it still points towards downside risks to growth going forward if supply doesn't pick up to more normal levels in the coming months. So that's still a key downside risk for Europe's economy and the euro. And then on top of that as well, obviously we've had the political situation in Italy has become even more uncertain this week, with Prime Minister Draghi resigning and snap elections being called for the 25th of September. And we think that political uncertainty will persist, obviously, over the summer months ahead of the election. And we can see still further upward pressure on Italian bond yields. And we think that would as well keep downward pressure on the euro dollar. We see that kind of still falling to and below parity in the coming months. Even though the ECB, like you say, this week has also announced details of this new kind of anti-fragmentation tool, the transmission protection instrument, they like to call it. To us, we're not fully confident at this stage that that's going to stop Italian yields from continuing to go higher in the short term. We don't think necessarily the ECB will be quick to come in and support the Italian debt market when the move higher in yields has been driven by political uncertainty. And I think the ECB ideally would like to have more clarity that the next government in Italy will commit to fiscal sustainability and also pass policies to push through economic reforms in Italy as well. If higher yields in Italy is what's required to force the next government to implement those policies, then that's probably a short-term price worth paying for the ECB to allow higher yields. So I think in that scenario, unless really yields in Italy spike significantly higher, I think the ECB will be kind of somewhat reluctant in the short term to come and use this new tool to support the debt market. So short term, at least, we still see some further downside for euro, even if the ECB has, like I say, speeded up the exit from negative rate policy.
Yeah, thank you very much. So all eyes on the Fed next week then. I look forward to catching up with you after the FOMC meeting, and have a great weekend.
Yeah, you too, Simon. Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.